Welcome to the Titans of Industry show, and I have a great guest on today. One of the most popular people online right now in the alternative media. He was a broker on Wall Street for many years, and we'll talk about that. And then he fled the country prior to 2008. So talk about timing. And then came back. Now lives in the U.S. and he is partners with James Sinclair at JS Mindset. Writes a lot on a lot of blogs and a very popular interviewee, Bill Holter. Bill, how are you today?
Good, Leo. Happy to be here.
I'm glad you're with us, and you know what? I'd like to start just because of the transformation and the change you made in your life, with how you got started and why. What made you pursue a career in Wall Street originally? I know you were a broker for many years. How did you end up in Wall Street, and what kind of ambitions did you have originally when you worked as a broker?
Yeah, most people don't have a clue what they want to do when they're in college. When I was 13 or 14 years old, I picked up a Wall Street Journal, started reading that, and then I started reading Barron's, and at 14 years old, I knew I wanted to be a broker. So, that's the way my mind works. It works, numbers, finances, economics.
And you grew up in New York?
I grew up in Connecticut, about 60 miles outside of New York City.
Okay, so straight out of college, you go to Wall Street?
Yeah, actually, I came out of college in '82, and that was the bottom of the '82 recession. I interviewed at 8 or 9 different brokerage houses, and they all told me I needed sales experience, and they really were not hiring. So I worked in the insurance industry for about 10 months, a year, something like that. And then interest rates started coming down, and the market started to perk up, and Wall Street firms were beginning to hire again. And chance would have it, I interviewed and was hired by E.F. Hutton, and 3 or 4 months into after I got my license and into production was when they pled guilty to the check kiting scheme. Some people may or may not remember that, but it was impossible to do business, so I changed firms, and I was a broker from '83 to 2006, and the last 12 years I was branch manager.
How, just so I can understand, when you work as a broker in Wall Street, do you see the inside, obviously you see the inside workings of how clients get treated, how people get treated by the brokers, and can you tell us a little bit about that experience, working on that side basically on that side of the trade, and not on the retail side of the trade, when you're the broker, not the investor? How is that?
Well, typically, and it's a problem, has always been a problem on Wall Street, is that the brokers look at their clients or client base as a cash register. It's their way to make money. When I first started with E.F. Hutton, one of the very first things I heard in training was that if you don't get sued in your first 2 years, you're not being aggressive enough. And I thought to myself, that's not the perception I had at all. My perception was, you're trying to help people. I went 23 years without ever a lawsuit, arbitration, settlement. And the 12 years as a broker, none of my brokers that I supervised had a lawsuit, arbitration, or settlement. That's almost an impossibility, but for the 23 years, I had a complete clean slate, which in today's world is, like I said, almost an impossibility because the world is so litigious today.
How was... did you work in 1987 when the market crashed big?
Yeah, actually, I got a funny story about that. I was still pretty new in the business, didn't see it coming. The market was down. I don't know, a couple hundred points, and a couple hundred points was 7-8%, and there were some issues that were off 15, 20, 25% or more. And I grew up in Connecticut. I'm a hockey player by trade, and I happened to have my equipment bag in my car, and I went out to my car and grabbed my hockey helmet, and I sat at my desk from 2 o'clock to 4 o'clock with my hockey helmet on. My branch manager came out, told me to take it off. I was being ridiculous. There was no big deal, and I said, "What do you mean, no big deal? Have you or anybody else alive ever seen anything like this?" But yeah, 1987 was the big day. Was not Monday. It was actually the next day. Was trying to get the markets opened. And looking back in retrospect, it was a $6 million trade, million with an M. It was a very, very small trade done on, I think it was the Value Line Futures, which was open but completely illiquid, and that's what turned the market. It's what saved the system. And that was our first bout with a derivatives meltdown scenario. And that's where we're headed now.
So, following 1987, following that day, what does it take for Wall Street to make the retail investor come back that quickly? The end of the year, end of 1987, the S&P was higher than it started the year, so that year ended up on an uptick. What I'm asking you is, do Wall Street brokers and firms do convincing campaigns as much as on the short side as on the long side, and who made the big money when these markets crash that artificially?
Well, the ones who made the big money are the ones who were short, obviously. If you notice, from 1987, we had another collapse into 2000, 2001, another collapse in 2007, 2008. The thing that brings people back is the snapback in the markets. In the old days, bear markets would last a year and a half. We went through the 1960s with basically a sideways chop. The 1960s was not, you didn't see big growth in stocks. As a matter of fact, by the end of the 60s, there was talk about the death of stocks and the death of mutual funds. But that's what brings people back is the snapback in markets, the all clear signal, all is well. And, you saw it in 2009, 2010, things were precarious, and in many instances, they changed the rules, like the banks. The banks no longer had to mark to market. In other words, they didn't have to admit that they're insolvent. So they've prolonged the game, but we're at the point now where the game really can't be prolonged much further because the interest rates have gone to zero. They can't go. You can't have negative interest rates, and that's a story for a whole other show. Negative interest rates would actually eat the system up itself. So rates are as low as they can go, and it goes back to Richard Russell's inflate or die. And each time they lowered interest rates, they would reflate the system. And the problem today is there's no room to lower interest rates, and there's no collateral left to borrow against to reflate. And you have to compare today's world with a Ponzi scheme, because that's exactly what it is. And in a Ponzi scheme, you always need new investors. Not only do you need new investors, but you need exponentially more new investors over time. And at this point, in the fiat system, the new investors is equated to new debt, new credit in the system. And we've gotten to the point now where even sovereign nations are or have reached debt saturation levels. So there's no real place to reflate, and that's what the problem is today. There's no there's no way to reflate the system.
Look, your comments bring up two things come to mind, and I'd like to address them later on in the interview. What I'd like to ask you now is, what made you see the problems in 2006, where you basically took your family off of, you left Wall Street, you actually left the country, is that correct?
Right, yeah, I retired, I actually, because I was under 50 years old at the time, left capital with the firm that I couldn't take until I was 50 years old, so I walked away from that. I just saw that there was too much debt, too much credit. It was a bubble, and the bubble was going to burst. Well, as a broker, you just see people walk through the door and say, they want to put $50,000 or $100,000 into the latest XYZ hot stock. And let me go back. One of the reasons my office did not have any lawsuits or go through any lawsuits is because I made the decision as manager in 98, 99 at the end of the tech bubble that we were not going to do that type of business. If people wanted to do that kind of business, they could go across the street to Merrill Lynch or another firm and do it. And of course, that stuff blew up. So that's a sign as a broker, people just blindly coming in and saying, they want whatever the latest hot thing is. And in today's world, it would equate to something like Snap or GoPro or whatever. Oh, and as far as another reason that we left the country, I saw what was happening with the way our government was acting. They instituted the Patriot Act, and it looked to me like if the financial system came down, we would have an overbearing government. And we lived in Costa Rica for 5 years, and after our Spanish got good enough, I realized that when the system comes down, we're not from there. There's a gringo population in Costa Rica of maybe 100,000 Americans and Canadians, and they will be overrun. When the banks go down, when the dollar goes down and their whole system runs on dollars, Anglos are going to be, they will be overrun. So we decided to come back to Texas, where we had moved from, and live with like-minded people. Interesting.
So I watched a very top-level conference this September 2016. Timothy Geithner was there. Many from the Fed was there. But the interesting guy was Ray Dalio, who I regard as one of the best investors of at the fiat era for sure. He started in 1973, which is 2 years after we got off the gold standard. And
yeah, he's a brilliant guy.
Sure. Now he says, and he said that straight to the Fed people. He said, "Look, the central banks are now out of tools. You've lowered interest rates. You've created currency. You've manipulated, inflation targeting. You've done everything you can with regards to PR, and now." He says the next wave of stimulus will have to be some sort of a direct injection of funds into the consumer straight. That's Ray Dalio. That's not the Fed or
right. That's straight monetization is what he's talking about. And basically, what he said there is what I just said: is that there's no area, there's no way left to reflate the system.
Sure.
And he's talking about, direct in the consumer's pockets monetization.
Now here's the thing, Bill. This was September of 2016. Now, month, he went and told clients, and I'm talking, this fund is the biggest hedge fund in the world. There is nothing even that comes close to this hedge fund. he told clients, and he told the in a banking conference, he said he fears that populism in Europe and the United States is reaching the levels of the 1920s and 30s, and he sees the markets are going to become very disruptive. Then, I've been listening to interviews and reading books about investing from when I was 16, when I started investing. I'm now 32. And for the past 8 years, I've been very immersed in the gold and silver community. I've heard and attended many conferences, and I've spoken to many of the most brilliant people in finance. And the most alarming thing I've ever heard is from the eternal optimist Warren Buffett, who said last year that he wouldn't be surprised if we have a 50% shakeup in stocks in the next coming years. And to hear that from him made it very viable. Do you think this is a possibility for the United States stock markets, the large indices like the Dow Jones or the S&P 500, to pull back 50% of the market cap of these large companies?
Yeah, it's very possible and probably should happen, but you have to ask yourself, if that were to happen, would the markets even stay open?
What will happen?
Because he's talking about it from a stock standpoint. And I think it's important, much more important, to look at it from a credit standpoint. Because if the credit markets are shocked, if credit becomes unavailable, then the real economy stops, distribution stops. And when I'm talking about distribution, I'm talking about going to your local Walmart or your local grocery store and there's nothing on the shelves. Now, I'd be careful. I think it's a mathematical certainty that the markets do close and credit does cease for a period of time. That is going to happen. It's a question of when. It's not a question of if any longer.
Now, in the last 2 days, you told me pre-interview that this was one of the most important things that has happened, and you talked about the last 2 days of trading for gold,
right.
And you've said that there were irregularities that are unprecedented. What did you?
Well, they're not irregularities. I mean, we've watched over the last several years. I mean, you can go back, and it really started in 2013. You can see these big paper dumps of contracts on the silver and gold markets on COMEX, and you've seen the price get crushed. You'll see gold down $20-$30. You'll see silver down $1 or more. And we've seen these intermittently, but fairly regularly. What we saw the last 2 days was something very different. We saw 22,000 contracts, which was roughly $3 billion, sold in a short time span. I think it was 10 or 15 minutes. And we saw 25,000 contracts sold in 1 minute yesterday, which is over $3 billion notional value. So you add those two together, and you're close to 7 or 8% of global gold production for the year. And what did it do? They sold the contracts on Monday, knocked gold down roughly $10, and it closed the day up $6. That's the first time I can ever remember where there was one of these fraudulent dumps of unbacked contracts that were actually gobbled up and gold turned higher. They did it again. I'm sorry, it wasn't Monday, it was Tuesday, and then today. And they did it again today, and gold's down, down $8 or something like that. So with selling 7%, 8% of global production in a very concentrated manner, they only knocked gold down, $5, $8? They got no traction out of it whatsoever. And that's got to be really scary to the shorts.
I want to address two things. First of all, the central banks have been net buyers of gold since 2011. Do you think there's a clear connection between how the commercial banks act on the COMEX and this policy by central banks?
I don't think there's a connection between the average central bank. I think there's a connection to the U.S. Fed and probably a connection to a deal possibly that we cut with China. It's my contention. It's obvious that gold is the anti or arch enemy of the dollar. So the best way to portray the dollar in a good light is to smash the price of gold, make it look unattractive.
Now, Bill, as we're doing this interview, this is April 19th. The gold price has just passed its 200-day moving average. It's on a 5-month high, but more than this, it's at a key breakout point where it's sitting on the 200-week moving average, going back all the way to 2011.
And it's a breaking the downtrend line.
Yes, so it's either going to explode higher towards the $1,500 per ounce, or do a similar move down. What do you see happening?
If we see a move down, I wouldn't expect it to be more than $25 to $50, and then another try at breaking again both the 200-week moving average and the downtrend line, which is now 6 years in force from 2011. As I was mentioning before, one of the reasons I think the price of gold has been suppressed is, and I don't have any proof for this, but I do believe that the U.S. has cut some sort of deal with China to allow them to accumulate gold.
Why would they do that?
To prolong the game, to prolong the power. Because China could easily come in and completely blow the system up. I mean, you could blow the system up today with a $5 billion, I'd call it a $10 billion order in physical gold, and certainly a $5 billion order in silver. You would blow the system up because that gold and that silver is not readily available and could not be delivered. So, maybe the deal was cut because China said, look, if you don't allow us to buy gold at these prices, we're just going to buy gold and the whole system will blow. So I do believe, and I can show you on the back of a napkin, that China has accumulated since 2009, 2010, they've accumulated 20,000 tons of gold. And actually, if you want to see the nuts and bolts of that, Alistair McLeod did a very good forensic analysis of China's accumulating gold over those years. He did that last year, so you can Google that.
I just spoke with Mr. Bill Holter for a good hour prior to recording, and Bill is absolutely dead set on the fact that the US dollar is on a death spiral. Fiat currencies are used worldwide, and the difference between them is the confidence level the people using them have in them and the government's ability to meet obligations and collect taxes. It's important to make a distinction between the problem the government has, or governments plural, and those of the private sector. People, entities, and even business entities and governments own wealth. So some forms of wealth, the better ones, are intangible, and the crisis can't take those away. Any crisis can't take those away. These would be your imagination to create solutions, your ability to work with people, to inspire, to lead companies, to lead businesses, your personality, and the way you nurture and develop it, and your willpower to make your life what you want it to be. No crisis can ever take that away. On the tangible side, though, all assets in the world have relative value compared to others. In ancient times, silk, salt, gold. Today, houses, cars, education, people, they value different things at different times. A monetary crisis doesn't tear up buildings, doesn't blow up cars, it doesn't, ruin factories or any of these real assets. They will still be there. The problem with the crisis is who will own them. All the crisis does is completely distorts paper assets and real asset prices. Some, more than others. As you live your day-to-day life, realize that savings represented by fiat currencies is in danger. Meaning, if you accumulate your savings in fiat savings, since other people are only willing to accept them because of the legitimacy of the US government or the EU or the Japanese government behind them, this might be the time where old systems are coming into question. And you can't bury your head in the sand. The last 46 years have brought the US government and most Western government to a state of fiscal irresponsibility, of monstrous proportions. What's happening is a slow shift over increasing of wealth from west to east. And if the East decides when the time comes to replace paper fiat with gold-backed currency, then years of patience of owning precious metals will instantly be rewarded. Get motivated to make personal changes, because our collective political power isn't sufficient as the alternative group, as the minority at this point, to cause meaningful change, while the masses are, completely numb. If you want to build a castle of safe havens, go to wealthresearchgroup.com/safe havens. And if you want to learn about Bitcoin and 2 new important cryptocurrencies, go to wealthresearchgroup.com/crypto profits. If you want to become a junior resource investor, we created a 2-part series on how professionals conduct due diligence on microcap stocks, and that will be at wealthresearchgroup.com/gold playbook. Wealth Research Group runs the Titans of Industry show, the Cannabis Pioneers show, so join us please week in, week out, as we meet and interview the best experts and get their perspective and opinions on politics, finance, stocks, government, and much more. Thank you for tuning in.